Hello and welcome to this week's instalment of Nucleus Investment Insights. As we round out what has been an incomparable year in so many ways, our focus today is fixed on Australia's favourite asset class, property. Casting our minds back to March this year, as the true extent of the coronavirus, both locally and globally, began to bite on both economies and living standards, it seemed highly plausible that property prices were in for a long overdue correction. With immigration levels reduced to zero, skyrocketing unemployment in many sectors, and the potential for long lockdowns and social isolation, the prospect of higher house prices seemed ridiculous at best. But now, as the Australian economy begins its long march to recovery, it appears that whilst there are still some trouble spots, such as inner city apartments, on the whole, the nation's property market has managed to shrug off much of the deleterious effects of 2020 for many reasons that we'll go through today. But will the reluctance of both mainstream political parties to let housing behave like a healthy market and fall, resetting the market, exacerbate Australia's housing affordability problem and allow the gap between the home ownership haves and have-nots to widen? Here to share his thoughts on the future of Australian property and how it may influence our portfolios, I'm joined by Nucleus Wealth's Head of Investments, Damien Klassen. Hello to you, Damien.
Hi, Tim.
And also on the line, fresh back from Queensland, we have our Chief Economist, Leith Van Onselen. Hello to you, Leith.
G'day, Tim.
Great to have you back. And just a quick reminder before we get started that we're only 80-odd subscribers away from 3,000 on YouTube, and we have the goal of hitting that 3,000 mark before the new year. So if you haven't already, please subscribe, click on the notification bell to be notified of when we go live or have a new webinar to watch, or follow us on your preferred podcast platform. We also ask if you'd like to take a moment to click like on the video now to help our show grow. And of course, for those listening in live now, feel free to drop in your questions in the YouTube live stream chat to have them answered along the way. So let's jump into the agenda for today. So we're going to kick off with why we were wrong on housing, then having a look at the strong economic rebound, household sector cashed up, rolling then into easy credit. I guess one of the big ones is collapsed immigration being the only obvious headwind, and then finishing off with smaller capitals to perform best, and then of course rolling into, as we always do, our investment outlook and how these themes can impact the portfolios here at Nucleus Wealth. So with no further ado, we can jump into mid-year housing predictions. We're wrong. Leith.
Yeah, g'day, Tim. Hello, everybody. Look, the issues I'm going to discuss today, or we're going to discuss today, are actually outlined in great detail on the Macro Business website, where we've released our end-of-year Christmas special report on the 2021 housing boom. And so basically everything here is just like the cliff notes on what's in that report. So I encourage you to go and read that if you want more information. But yeah, basically 6 months ago or so, as regular listeners would know, we were pretty negative on housing, very bearish, predicting double-digit property losses driven by Sydney and Melbourne mainly. And this view was based on, basically 5 different factors. First being obviously collapsing immigration and a big rise in dwelling supply. We expected rising unemployment and as well as falling household incomes to weigh on house prices, and also, of course, the unwinding of a huge amount of mortgage repayment holidays and emergency income support, which we thought would crunch households and cause some forced sales. And at that time, we also expected credit availability to tighten because banks would become more worried about unemployment and people's ability to pay mortgages. And I expected that despite the fact that obviously mortgage rates were so low. And finally, the other headwind, or not really a headwind, but certainly not a tailwind, was that at that stage, I didn't really expect mortgage rates to fall, even with further cash rate falls, because at that point, I thought basically the mortgage rates hit their lower bound because banks wouldn't be able to pass on any further interest rate cuts without crunching their margins. Now, as we'll discuss now, we're pretty much wrong on just about every one of those counts, and listeners might remember, I can't remember when it was, might have been August or around about then, we had Dr. Cameron Murray, a buddy of mine, on to basically do the bull and bear case for housing. And as it turns out, Cam, if you're listening, you were right, buddy. I was wrong. Pretty much it's played out the way Cam thought it was going to work out. and hasn't played out the way I thought it was going to work out mid-year. But anyway, that's that's 2020 for you, crazy year. So pretty much, I've basically turned from a I guess a housing bear mid-year to now a housing bull. So I've totally changed teams, done a 180 U-turn. And first of all, I guess the first thing, there's a couple factors we need to talk about regarding why I've changed view and why I think housing's going to bounce pretty hard next year. First of all, is obviously the Australian economy has performed way better than we expected, and I think pretty much better than anyone expected. First of all, as we know, Australia's handled the COVID-19 pandemic extremely well. Pretty much us and New Zealand have been two of the world's best managers. Although we've had a couple new cases today in Sydney, apart from that, we've pretty much eliminated local transmission of the virus. The domestic borders are all open now. The economy's opened up pretty much everywhere. And because of that, as it's turned out, the federal government has pretty much overstimulated the economy with stimulus. Now, this isn't throwing any shade on the federal government. Obviously, when they announced these measures, nobody knew that we'd recover so strongly and that the pandemic wouldn't be as bad. And in fact, if it was up to me, up to me and probably up to us, I assume, we would have actually thrown more stimulus at it. So this isn't a slight on the government's response, but it just happens to be that the economy's recovered so strongly that we probably didn't need as much stimulus. But I've done a calculation, just a back of the envelope calculation of how much stimulus was thrown into the economy in terms of income support in just the June and September quarters alone. I've calculated that as about $180 billion of support. So that comprises the initial welfare boost, which was $18 billion, JobKeeper payments, $71 billion, Job Seeker and the other coronavirus supplements, $28 billion, the business cash flow boost, $28 billion, and obviously early superannuation release. So that's allowing people to access their super early. That also contributed another $35 billion into the economy, pretty much in the last two quarters, which is a huge amount of stimulus. And partly owing to that, and obviously, the border reopenings, etc., outside Victoria, we had a really strong and much stronger than expected rebound in growth, where state final demand rebounded over 4% in the September quarter, and that was all driven by household consumption pretty much. And that became despite the fact that Victoria was still closed and actually took away from national growth. So we had effectively 25% of the economy shut down, and yet we still had that massive bounce in growth and a huge rebound. So it was definitely a big bounce. And I must admit, I'd already kind of bought into the bullish case on housing, but then when the Q3 national accounts came out when I was in Queensland last week, I think it was, or a week before, and I started going through those, I was just gobsmacked about how big the recovery is when I drilled down to the details. Probably the biggest area which relates to housing is the fact that despite wages and salaries falling, all this stimulus has actually driven household income through the roof. Now, if anyone's watching this online, you have the slides in front of you. If you go to the household section, I've got a few charts in there to show you just how big the household disposable income boost was.
Just before we jump to the next one, Leith, just still on that last slide, we've got the five components that you've pulled out there. Have you done any work on the income tax cuts that sort of came through in the delayed budget? I'm not sure if that could be roped into Corona, but...
Yeah, no, not that. That's actually not included in this. I didn't even include that in here. I do mention it or in the report as something that'll support the economy as the unwinding of JobKeeper and Job Seeker happens next year. Well, that'll be partially offset by the tax cuts, but I haven't even mentioned that in here.
Yeah, sure.
Because that came pretty late in the piece, and it's probably pretty minor compared to these things, which are basically direct, cash flow boosts.
Yep, sure.
Yeah, huge. So that's not even included. I think the tax cuts will be more an issue for next year. But, irrespective, so basically we had a situation where household disposable income, because of all the stimulus, rose by about 6.5% year on year, which is a huge jump when we've had effectively, hardly any household income growth for a decade. And at the same time, obviously, because of all the shutdowns, household expenditure collapsed. So as a result, net savings for households has gone through the absolute roof. And households effectively saved about 15% of GDP in both the June and September quarters just from banking all the stimulus. So households have accumulated this massive war chest of savings, which is effectively, I guess, pent up stimulus. So it's stimulus that's been banked and can be spent now and obviously next year. So that's one of the reasons why I tip in a big economic bounce next year. I'll get onto that a bit further. If you're watching the slides live, go to the next slide, and I've actually got the household net savings on rolling annual terms, and there was effectively $166 billion of household income saved in the year to September, which is a massive increase in about the 40 billion the year before, and 77% of that, so just over three quarters of that, came in just Q2 and Q3 alone, and that's all stimulus as well as households not being able to spend. So they've effectively just had all this money getting thrown at them, a big pay rises through big cash flow boosts, because even though their wages and salaries went down a bit, they got all this extra money from the government, from their superannuation release, all this extra disposable income, and at the same time they couldn't spend it. So they got this huge build-up of savings, a big war chest. And as we know, household consumption historically has comprised more than half of Australia's growth, 55%. So my view, I guess my prediction is that all this pent-up savings or saved stimulus will be spent pretty much now and into 2021. And that's inevitably going to drive up growth as well as leak into assets like property. And it's going to provide a pretty big tailwind for the economy and I guess the property market and other asset markets. And that should more than offset the unwinding of the stimulus that's going to come in 2021. So obviously we're going to have JobKeeper unwound slowly. We're going to have the job seeker coronavirus supplement unwound, although I believe the government will probably end up lifting that permanently by, say $100 a fortnight. But so while those are negatives, you got obviously this huge amount of savings that is pent up stimulus that's still to be spent. At the same time, we're going to have wages and salaries rise anyway because the economy is recovering, and that's going to offset some of those stimulus withdrawals next year. Now, the other I guess probably the bigger impact on the housing market is that the mortgage match has been lit by the federal government. So, and the Reserve Bank. So basically, as I highlighted earlier, mid-year, I pretty much thought that mortgage rates are bottomed because the banks, given how much it costs them to borrow, were unlikely to be able to cut their mortgage rates without eating into their margins, and that was a wrong assumption because the Reserve and I didn't realise this at the time. I didn't really see the gravity of it, but the Reserve Bank implemented its term funding facility in I think it was late March or April, and what that's effectively done is they're replacing the bank's wholesale borrowings with extremely cheap funding from the RBA, and started off at 0.25% they could borrow from the RBA. Now it's only 0.1%. And what this has effectively done is it's created mortgage rates. So it's had the biggest impact on fixed mortgages. So those have fallen to 2.2% for 3-year fixed mortgage. That's the average rate. You can actually go below 2% if you shop around. And even variable mortgage rates have also fallen by a meaningful amount. So that's obviously made money extremely cheap, a lot cheaper than I was ever expecting, and a lot cheaper than I think anyone's expecting. And at the same time, obviously we assumed that credit standards would tighten because obviously all the unemployment concerns and concerns around people's income and ability to repay and all that sort of thing. But then we talked about this a few podcasts ago. Treasurer Josh Frydenberg announced in late September that they're going to axe responsible lending rules, which directly contravened the first recommendation of last year's Banking Royal Commission, which was to keep those rules and obviously tighten lending standards. Instead, the federal government has announced that they're going to get rid of those lending standards. Josh Frydenberg has also declared war on ASIC. He wants to restructure ASIC because he sees them as not bending to the will of the political parties. He's angry at them for enforcing responsible lending. So although these rules haven't officially been passed by Parliament, it's effectively red rag to a bull. and it's greenlit banks and mortgage lenders to basically ease standards and lend to pretty much anybody with a pulse. So we've got this combination of incredibly cheap money and also more available money. So that's a pretty much a dynamite combo. Certainly one that I wasn't expecting. So there you go.
And it's worth saying, Leith, you've spoken a lot about the positives. I guess it's a lot to me. A lot of the switch as well has been that the negatives haven't been allowed to go on. So mortgages got suspended. You didn't need to pay your mortgage if you couldn't for 3 months and then 6 months, and then it got extended out to a year. And then there's bankruptcies and evictions that have sort of been through that same type of push. Not just in Australia. This has sort of been a global event.
Also, JobKeeper and JobSeeker were extended too. They were extended several times.
Yeah, and so for me, there's still this latent problem out there, which is if you told everyone tomorrow, right, everyone who can't pay their mortgage has to go through the usual thing and have to sell the house or go through bankruptcy or whatever it is, then you might have problems. But it does seem as if, especially with the vaccines coming out now, that it's a March date at the moment. Given there's vaccines, it seems like that'll probably just get extended again as well.
Yeah, absolutely.
And so that, I guess what I'm saying is, it's not all completely, there's still risks out there. You need to be cognizant of, and if some of these factors do change, then there's risks. But at the moment, it seems as if we've basically taken what would have been an ordinary downturn and potentially a bigger downturn because of debt crisis, and basically thrown more debt at the problem, and tried to stop the downturn. And so therefore, it just means we're building ourselves a bigger pile of dry tinder. But at the moment, that looks like it's going to be 12, 18 months before it's of a concern.
Yeah, absolutely. Look, we're certainly going to build up, do another ramp up of household debt, et cetera, and just kick the can down the road. But I guess, I'm only looking 12 months ahead the next year. I guess we can do this podcast next year, and we might have a different conclusion. But the thing about the mortgage deferrals, that is important. Obviously, they were extended again. But at the same time, the number of people with mortgage deferrals peaked at about 500,000. So it was 500,000 borrowers who deferred their mortgage at the start, and the numbers of those have shrunk quite considerably. So they're actually, I think they're down by about 2/3 already, and that data is fairly lagged. It was from a couple of months ago. So, so that problem has been evaporating anyway. And I think by the time March comes around next year, and it's scheduled to, all the mortgages all the deferrals are scheduled to stop, they'll probably extend it anyway by another 3 months. But even if they did, the risk is way less anyway, because there are far less people who are
at risk.
At risk. That's right.
So actually, just on that, there's a question here from David, and thanks, David, for subscribing as well. Is it possible that you were not wrong just early as the government and RBA stepped in to delay the inevitable, and now your revised forecast might be wrong as the government starts to retreat? So, as in you were right originally, and the bullishness
it's all possible. I just don't look. Obviously, there's a million things that could happen. So New South Wales has got this little mini outbreak of 5 COVID cases today, pretty much, and yesterday. And who knows, that could spiral into something worse. We could get any number of things could happen. But as it looks now, I just think the risks are for a pretty strong house price bounce next year. And I think the government and RBA have shown their intention to let this happen and to let it run and to do everything they can to ensure that it happens, at least in the next year or so. What happens after that, who knows? I mean, forecasting is hard enough to do it over 6 months, let alone 18 months, 2 years, etc. Especially in a crazy year like we've had. And as I mentioned in the report, one of the problems we had as economists and analysts is that we were pretty much reliant on data from, whether it's the ABS or Treasury, that was always lagged, and it's telling you an old story, so it's very backward looking. So, for example, when the September quarter national accounts came out, the June quarter national accounts came out, which were absolutely disastrous, and showed that growth had crashed 7% and etc. That only came out in early September, and it could have been that by that stage the economy was already turning, but we were relying on data that had just come in, already two and a bit months old.
Yep.
So that's been a problem we've had, and that doesn't usually matter so much in normal times because the economy doesn't move this quick. But in this time, there was we're basically flying blind, and you kind of go from what you think's going to happen and gut feel, etc. And then when the data actually hit for the September quarter, only came out in early December, it was like, oh my god, this is huge, and pretty much the only place one of the only sources that gives you reliable real-time data is actually Gareth Aird at the CBA, because he's now started publishing his CBA's own internal data, and I actually find it in many ways better than the ABS's, and it's more current. But even then, it took me a while to believe that because it hadn't been sort of back tested against the reality. So I was a bit skeptical at the start. I was like, is this data dodgy? But yeah, that's been the main problem. So it's probably better now to rely on those sorts of sources when you want to pick turning points. Because in this case, I must admit, I completely missed the turning point.
Yeah,
and I think a lot of people did.
Tim, it's worth noting though, going back to those ideas that you go through debt cycles, and you have short-term debt cycles and a long-term debt cycle, and when this huge long debt cycle that's just building up more and more debt, and then the short-term ones, peak and debt trails off, and then you have your sort of economy goes backwards, and then up you go again. I guess our take was always that that was what was going to happen this time, was that the coronavirus in itself was a sudden shock that wasn't really on its own wouldn't cause massive problems, but over sort of a medium term. But the fact that we were it was hitting us right at the peak of the cycle, and we had all this debt, and that was what was going to trigger this next sort of downturn.
Yep.
And the fact that so much stimulus has been thrown at it, and so much debt, and so much extra debt, and all the we're calling it suspension of capitalism, effectively, that if you can't pay your mortgage, that's fine. If you should be bankrupt, that's fine. Keep going. All those types of things that happen have meant that it does look like we're going to push into the next the next upswing on the back of all this government stimulus. And so then it's a question about, as that one starts to fade, is the next downside going to be further? Absolutely, because you haven't had your sort of clean out this time.
Yep.
But it at the moment, and I don't want to sort of go too far out. I don't want to say that this is all guaranteed to happen, but at the moment it does look as if we're not going to get that downturn, and there is going to be this next leg of debt-driven stimulus sort of pushing markets for say another 6 to 12 months. Beyond that, you have to be quite concerned. I mean, that's the biggest risk now is we're in the hands of governments and central banks. Like we're basically that's all that's driving it, is the amount of stimulus, and we will get a bounce back from people, but especially in Australia, people are already pretty geared up, and so there's sort of limits to how much more they can gear up.
Okay.
But it still comes back to, when you're in the hands of central banks, the concern is that they make a mistake in terms of pulling out too quickly, or whatever in terms of policy type errors that can send it back down the other way.
Yeah, fair enough.
I actually think, I absolutely believe we will get a day of reckoning. It's just not yet. Because if you do look ahead, you look at where's the mortgage rate at the moment. Probably if you average out fixed and variable, and et cetera, it's probably 2.6% would be the average market rate at the moment.
Yep.
Yeah, about that. And you just wonder, well, how much lower can it go, and when do you finally hit that lower bound where it really can't go any longer, get any lower?
Well,
negative rates.
No, absolutely could have negative rates, but even then, I mean, is that going to be 1.9% mortgage rate, 1.5? But eventually we'll get to that point, and when you get to that point, it's pretty much, I mean,
European rates are 0.5%, because
for mortgage rates, though?
For mortgage rates, yeah. The ECB, there's lots more that can be done on that front. The ECB is basically paying 1% to banks, and mortgage holders pay 0.5% to banks.
I mean, I suppose my point is, when we eventually get to that point, is probably when it'll end. Who knows? I mean, based on that, honestly, if you'd asked me 12 years ago if we'd ever have QE, I would have gone, nah, that's crazy. and now look.
Sure enough.
And a year ago I would have thought, oh no, it's crazy, like 0.5% mortgage rates. It's impossible. Well, it's not. So always be prepared to be surprised, I guess.
That, and just on that, so that 180 billion that you sort of roughly back of the envelope, what's that as a percentage of GDP that was basically doled out in 3 to 6 months?
Oh, it'd be huge.
Yeah.
Trying to
12?
think. So
12,
yeah, it's
12,
massive.
Well over
It's
10.
massive.
Yeah.
Yeah, it's
Just-
huge. So it's about that 2 trillion-ish.
Yeah.
The economy's just over that. Yeah, it's huge. So I mean, look, the households alone saved about, I think, 15% of GDP is household savings in the June quarter, about 13-ish% in the September quarter. So, that's a massive war chest. And I guess I focused on households. In the report, I actually go into all those 4 drivers of final demand. So I go into business investment, dwelling investment, public investment, and households.
Yep.
But for the purpose of this housing market report, I just focus on the households because that's the most important for housing. But I do go into all those stuff and all that other stuff in pretty, quite a lot of detail in the actual report. It's just it's just too much to talk about today, I guess.
Yeah, fair enough. All right, very good. Anything else for this slide, or we'll jump into property demand?
Go on the next one. Yeah. So basically, this gets the meat and potatoes of it. So we've got basically, obviously, households cashed up. We've got easing credit conditions and cheap credit, and expected to send property demand surging. Now, I've got 2 charts here, which are pretty good historical sort of charts I like to use. The one on the left here is more important. So what it does is it shows the annual rate of growth in mortgages, excluding refinancings, versus the 5-city dwelling price growth. So that's from CoreLogic. And mortgage growth typically leads house price growth, as you'd expect. And mortgage growth's obviously bounced. So that suggests, even on this, which is backward looking, that prices are going to surge. It's not really rocket science. It's pretty obvious. But and also, obviously, the other one is I've got capital city auction clearance rates versus price growth. And auction clearance rates have also bounced, which also obviously points to rising prices, and auctions tend to lead the reported price growth. So basically expecting all markets to rise next year. I mean in an aggregate sense. So not certainly not apartments in Melbourne or apartments in Sydney, but dwelling values overall. I expect all the major markets to rise. And my tip is
that's an interesting qualification too, isn't it, Leith? Is talking about it's talking about the desire for people to have houses rather than apartments.
Oh, absolutely.
The poor quality of a lot of the apartments have come on, and also the amount of building that's actually been done and still coming online in terms of
the collapse in immigration.
Yeah.
And also obviously apartments tend to be rented more, and they're way more reliant on net overseas migration, especially international students, and that market's obviously dried up. So basically, the upshot is, sorry, go on.
And then the question though comes back to investors then. So for investors who typically are looking for an income stream, we hope a lot of them are looking for an income stream. The question for them then comes back to saying, well, if your rents, I'm assuming you're not expecting rental growth to be very strong at all?
No, absolutely not. Well, it depends. Rental growth should be positive but not in Sydney and Melbourne. But Sydney and Melbourne houses might go up, but the apartments are crashing. So, basically the apartment market in Brisbane, Sydney, and Melbourne, rents should be weak. Everything else should be good.
Okay.
So, even despite the collapse in immigration. So
so then the question comes back to houses, especially I guess in terms of regional houses, you would think would be there's going to be less. It's going to be easier to get more supply on in terms of that area, and it's a lot faster than apartments. So does that gel with what you're seeing?
So basically, on the supply side, it's interesting. So we've got the apartment market, apartment supplies falling pretty hard. I mean, it's don't get me wrong, there's massive oversupply there. But I'm talking about flow of apartments.
Yep.
But the detached house market supply is actually ramping up pretty quick, and that's on the back of obviously stimulus. We've got home builder, which is geared towards detached houses, and we've also got the first home buyers, first home buyer grants or subsidy scheme, I think it is, which applies to new dwellings, and that's also juicing the detached house market. So the actual forecast of detached house construction to increase, and in fact overall construction increase, but that to be concentrated in detached houses.
Yeah, and detached houses tend to be a lot better for the economy as well, don't they? In terms of it being,
they employ
the
more
spend
persons
is
per
bigger,
dwelling.
employ more people. Yeah, that's right. You're not,
And
there's
they're also quicker to bring online, so they're a lot more responsive to moves in the market.
Yes. Yes. Still not that responsive. You're still talking about years.
No.
But yeah, it's also maybe a year to 18 months.
6 months to a year versus 2 to 2.5 months, sometimes 3 years for a high rise.
Yeah, that's right.
So
just on those, and we just got those two, the price growth and charts up still. Leith, the question I had was, so you've got the percentages there, annual growth rate percentages on the left-hand chart, and obviously percentage can hide the quantum though. Has there been anywhere near the amount of houses change hands this year as there would have in the past, or is it are we getting rises off a low base?
No. Well, yeah, certainly supply has been constricted, and that's part of the thing. The amount of actual turnover is down, and there's also a lot less homes for sale. So it's a much thinner market than it was, say, even a year ago, when obviously the housing market was booming pre-COVID.
Yep.
And that's excluding Perth. Perth's actually having a massive, increase in volumes, but yeah, aggregate wise, it's down.
And Perth though had been falling for 5 years, as you said, so a little bit
6 years, 22% over 6 years.
Yeah, so a little bit that's the reversal at the end of it.
So just that. So obviously, it's, if you know the recent chunk of the chart there's on thin data, kind of feels like there's, is it safe to be able to say that, on a low volume that's this is the way it's going to go forward, or do you think is it no potential of it just sort of wallpapering over some cracks?
Oh no, look, I'm not. This whole report's about property prices, right?
Yeah.
So it's not about whether the housing market's sustainable or whether it's good or whatever. And I'm only looking at 2021 here.
Sure.
So yeah, obviously it'd be actually good to do this podcast in 12 months' time and then see how our views have changed, because they probably, we'll obviously be a year down the track, year of more debt, year of values been higher, et cetera, et cetera. But yeah, right now just looking at prices, and it's just all the momentum bar immigration is pretty much pointing the one way at the moment.
Yep.
And that takes me to the next slide. I'll just segue into that, and then we can talk about the other stuff. Basically, so I've got a whole bunch of predictions, or forecasts in the report. Take them with a grain of salt, with all forecasts. But basically, I'm predicting that the smaller markets, in this particular order, Perth, Brisbane, and Adelaide, only looked at the top 5, will experience the strongest growth, primarily because these markets were already relatively affordable. There's a whole bunch of charts in there where I do the relative valuations of each market against the other capital cities. And Perth's trading at its most affordable level versus the other capitals in 50 years. Brisbane and Adelaide are not quite at the most affordable, but close to and well above average in terms of relative affordability. So this is just looking at compared to the other markets in Australia. And obviously these markets are way less reliant on mass immigration and than Sydney and Melbourne. Sydney and Melbourne also expected to rise in value just on the back of cheap credit, low mortgage rates, recovering economy lifts all boats. Sydney expecting to be a fair bit stronger than Melbourne, but weaker than the other 3. Both these markets are riddled with oversupply at least in the apartment space, and obviously they're already very expensive to begin with. Their relative affordability to the other markets is not at the highest level ever, but pretty close to. And Melbourne's more unaffordable than Sydney, based on relative valuations. So I'm expecting, basically if you have to do the pecking order, it'd be Perth, Brisbane, Adelaide, Sydney, Melbourne. All of them will rise, but Perth the most and Melbourne the least.
Okay.
And I've got a whole bunch of percentage ranges, which, to be honest with you, it's it's not it's not based on anything but just reading these, reading all these charts, and
Yep.
I present a whole bunch of other data in there as well, and a bit of gut feel and whatever. So
Cool.
take it with a grain of salt.
Fair enough.
But if you want to, like most of these reports, it's more the discussion, everything that's the most interesting about it. And no doubt it'll end up being wrong anyway, because just about anyone's forecasts usually do tend to be, part right, part wrong, whatever. But have a read and see what you think, and hit me up in the comments.
Sure, mate. I've got a question here actually from Daniel. Perth's rental market seems to be incredibly tight. Will this impact on investor-heavy property prices such as inner city units? If so, when?
Perth's rental market's really tight.
Yep.
So basically Perth had, as mentioned before, so its prices fell 22% over 6 years. Its rents actually fell 22% over 6 years, exactly the same. And they basically had a massive dump in population, but they also had a massive dump in supply. Now population growth's been picking up for the last year or so, and the supply hasn't picked up yet. And it's really tightening quick. I think its rental vacancy rate was at about 0.9%, and that's after it peaked at over 5 or 5 or 6%, a couple of years back. So it's really tightened up, and since COVID hit, its rents have gone through the roof. I think 5 or 6%, even in the 7 or 8 months since COVID hit, and its unit market's also going up. So I think it's going to be pretty much across the board there. Probably still better for houses. They're more desirable. And the other thing about Perth is obviously we've got an iron ore boom going on at the moment, so that's also juicing the market. So yeah, Perth's rigged to blow.
Yeah, I think there was an issue there for a while where people who were fly out couldn't actually fly out of WA, so they had to stay in state for the next swing, which probably put a bit of short-term upward pressure on demand. We've got another question here as well. How much of the movement into Brisbane is due to people leaving Sydney and Melbourne so they can clear debt? Thanks, John.
John, that's a good question. I must admit, mate. 3 months ago, we were in lockdown. I was dying to move to Brisbane. So we'll move to the Gold Coast, and I've been pestering my wife for about 5 years to move up there. But look, I think there's going to be quite a big exodus, especially after the crappy year Melbourne's been through. I'm talking more Melbourne. Obviously, Sydney might be the same, but probably not as bad. And I wouldn't be surprised if we have a repeat of the early 90s where a lot of Southerners went up north to Queensland, because it is so cheap up there. The property there is ridiculous. You can get a detached house up there for about 700,000, which you'd pay 1.2 million plus in Melbourne, and way more in Sydney. And it's just obviously all this work from home, all this COVID stuff, etc., and people are looking for lifestyle properties. And I think Southeast Queensland's going to be very enticing.
Yeah, and see, this is the interesting one for me, Leith. Is it's not just there, but I think you spoke as well about regional areas. There's been a number of regional areas where prices have actually been quite strong, and the question for that is, if you keep strict land supply and you don't let people build, then you can keep those prices high. But a lot of places have, there's a hell of a lot of land in South. In the east coast of Australia or west coast of around Perth that's available to be developed on. Just a question of whether it's now planning restrictions, isn't it? As to whether.
Oh yeah, and pretty much nowhere in Australia has your Houston style open land supply. So you still have to go through councils, go through all that stuff. It's got to be zoned, blah blah blah. Certainly that'll keep prices higher than they maybe should be. Then you're right, there has been Infrastructure Australia did a report yesterday which came out on the shift to regional areas, and they said it's gone up, there's been a 200% increase or so, or maybe it's 300% to regional areas in the wake of COVID. So and we're seeing that in CoreLogic's released a report today, which I'll put up in Macro Business tomorrow, on the fastest growing areas, and it's actually lifestyle areas that have gone up the most, Sunshine Coast in particular. So yeah, there is this, I think with the rise of work from home, more telecommuting, bosses are more, willing to let that happen. People want lifestyle now. They don't want to. I think there's been a bit of a shift away from inner city living and living in a sardine can to wanting to move to these kind of places that are cheaper and offer bigger blocks and obviously better lifestyle,
Bit of lifestyle.
bigger bang for your buck.
Yeah, sure. We've got another question here from Alec, and probably just a bit of background. So obviously we had those superannuation withdrawals that were allowed, the early release, which was tipped a lot of that was going to go into property. So we've got here numbers on first home buyers and could they be exhausted? And with bad rents, we wouldn't expect investors to make up the bulk of the demand.
Yeah, well,
going forward.
That's actually really interesting because this cycle's different. Actually, it's probably pretty similar to the GFC cycle, at least initially, in that all the mortgage growth, the mortgage market's absolutely exploding at the moment. And except this time around, it's been driven by owner occupiers, and that includes obviously first home buyers, whereas investors are still very weak, which is different because the last several housing cycles we've had pretty much since the GFC have all been investor led. So yeah, no doubt, a lot of first home buyers have used their early access to super to scrape up a deposit. I got no doubt that's happened. And at the same time, the government's thrown quite a few incentives at first home buyers as well. So yeah, that could very well get exhausted. Just don't think it'll get exhausted in time to impact prices next year. That could be more a 2022 story.
Okay.
The other thing is during the global financial crisis, when the Rudd government introduced that massive first home buyer grant, you saw mortgage demand initially was driven by first home buyers, and then as that eased, the investors took over. And honestly, I can't believe that investor demand's so low at the moment, because especially if you look outside of Sydney and Melbourne, and you look to these other markets, you got pretty sweet rental yields on offer. The gross rental yield.
Well, relative to mortgage rates.
Yeah, absolutely.
Yeah.
Oh, mate, it's pretty obvious. It's not hard to get a neutrally to slightly positively geared property even in Brisbane, because they're offering gross yields of 4.2% for houses, and obviously you take out your costs, but that means there are areas there which offering above that, and when you can potentially get a mortgage for 2.5%, that's pretty tasty. So I wouldn't be surprised if you start getting the investor raters going to WA, going to Perth, South Australia, Queensland, some of the other markets just outside of Sydney and Melbourne, just because the rental markets there are still pretty strong. They're not as affected by the fall in immigration, and there's juicy rents on offer, rental yields on offer, in this era of very, very low interest rates. It suddenly makes all that stuff way more enticing.
Yeah, and just while we're on the topic of investors, another one from Alec. China would be very cognizant of our housing bubble. What if they were to punch us where it hurts by forcing selling by Chinese migrants and investors? Are there any numbers on foreign home ownership or foreign investment at this time in your states?
Foreign demand has been really quite low for several years, but that doesn't mean they don't own a decent stock of homes outstanding. Unfortunately, there's almost zero data about this, but who knows how much they've accumulated in the last decade. And if there is somehow some way that they can force a whole bunch to be sold, I don't know how they do that. But yeah, I guess that could have a downward impact, but probably not enough to scuttle property prices in 2021. It could happen, I guess, later, but we'll wait and see.
But I think it's still coming back to that whole point, isn't it? If you've got a lot of debt in a market, you don't need much of a swing to start causing problems. But at the moment, everything's pointed in the opposite direction, and everything's pointed towards just getting people to gear up more. If people can't pay their mortgage, that's fine. Let them extend so there's not, you don't have the forced sellers out there that you would have had in an ordinary economic downturn. And it's an interesting economic take, is that in a traditional economic cycle, you shake out some of the weaker and some of the people who have overgeared in crises, and then that sort of clears out the underbrush and gives you sort of room to grow again into the next growth phase. But we've sort of declined to do that this time, and so there's this short-term push, but the medium term looks worse for this type of outcome. But it's a better short term, so better year, 2 years. But your 5-6 year view is that lower demand, lower growth, all these other factors that sort of tick through because of this huge debt burden that's just being accumulated to sort of get over the short term issue.
Yeah, well, I think that was he'll no doubt correct me if I'm misquoting him, but I think that was Cam Murray's point in our podcast months ago. He basically said that, you know, I was arguing that household income is going to have a big hit because of all the unemployment, and he'll say no, they're going to get more money than they had otherwise. And he was right. It's been a wonderful recession for if you look at the aggregate for a lot of households. I mean, the household disposable income rose a lot. And at the same time, company profits boomed. And this is all on the back of artificial stimulus. Now, obviously, that'll wash out.
It's a transfer from government to consumers and particularly to businesses.
That's right. Yeah, absolutely. And obviously, it's artificial. But you know, it's still pretty good for 2021.
Yeah, that's right.
It'll definitely cause problems down the track.
And that's still that point about saying that, you know, when you're in the arms of the government and central banks to make this happen, that's what you have to watch now. It's not as much watching economic conditions and recoveries and all that type of stuff, because it's more about what are central banks and governments going to do in terms of the policy side.
Yeah, well, it's no longer a market economy, is it?
No, absolutely not.
Very good. Well, I think that might be it from the questions so far, but feel free to drop in any more, anyone that's listening in, and we'll get to those. Do we want to jump across to the investment implications?
Yeah, sure. So similar. I've put a pretty similar list up the last couple of weeks, just talking about these, this clash of the positive factors and the negative factors, and that it looks like on the key negative factors, the virus in the northern hemisphere was the one key thing that might have derailed some of the growth. That most of those are sort of longer term issues, and then the key positive ones are are all happening at the moment. And so I think there's until we start to see these factors turn down, we're sort of, and until we start to see governments decide that yes, we will return to capitalism and let companies, not manipulate interest rates and let companies go broke and all that type of stuff, then you need to take into account that these are generally positive factors for asset markets and risk markets.
Okay, yeah, sure. And I guess vis-a-vis the property sort of side in the Aussie stock market, things like real estate investment trusts, Damien, has today's thoughts changed your mind anywhere there?
Well, there's still terrible vacancies rates throughout.
Commercial is a different matter.
That commercial property market, and you're probably going to see some conversion of some of those into residential at some stage. There's probably a decent chunk of supply to come from converting your average strip shop that's now there's with six places all unleased in a row. You're starting to convert those into houses, so I'm not that keen on that part of the market, depending relative to price. There's some of the residential construction though it certainly looks like there's some positive stuff coming through in terms of that.
Okay, yeah, sure. And just finally, actually, just on this infrastructure, has there been much thought of infrastructure in our portfolios? Obviously, increased demand for houses leads often to people moving to areas. Particularly, we've spoken a little bit about a bit of a disembarkment from the CBD, people getting out of smaller places into larger ones. Is that sort of leading into some opportunities for infrastructure going forward?
Look, the big problem for infrastructure is it's quite interest rate sensitive, and so it's a matter of weighing up the growth versus the return you can get. So the idea, I guess what I'm saying is, if you can pick up a 5% yield, say on some infrastructure assets, and that's relative to sort of long bond rates of about 1%.
Mm-hmm.
If we get a bit of an inflation scare over the next 12 months, and that's quite possible, is that you might see that those yields actually start to rise on those assets. So at the moment they're sort of, you can get a long bond for 1%, and you can pick up some infrastructure assets for a 5% yield. If the long bond goes to 2%, well, maybe that 5% yield turns into a 6% yield, which means the price has to fall to get it there. And so you'll have growth on one side picking it up, but potentially that capital loss on the other side. So we're sort of trying to play that more about saying we do think there will be a bit of a bond backup and a bit of an inflation scare, but we don't think it's real. We think it'll there's all this stimulus will come about, and people will be talking about how much inflation is going to get going. But as soon as they try and withdraw the stimulus, that's where the problem about having such high debt levels and will start to come home. And so so that's a buying opportunity for sort of mid to late next year, we suspect.
Right. Okay. Very good. All right, gents. Well, look there. Thanks very much for that, and thanks, Leith, for sharing with us your the highlights of your report. And make sure anyone listening in, if they head over to Macro Business to catch the full report for the Macro Business Christmas property report. Really appreciate your views, and I guess always interesting to see who's a long-time property realist has suddenly turned a little bit bullish as well. So good on you, Leith.
It's a fabulous backflip, isn't it?
Yeah. Well, look, you've got to look at the data, and you're a very, very data-driven guy, mate, and
absolutely
always ready to make a decision. So very good. Thanks for your time. Thanks to you, Damien, as well.
Thanks, Tim.
All good. And we'll jump across to our viewer question of the week. So we've gone through a lot of upside, but what do you think stands in the way of Australian property in 2021? I'd be interested to hear your thoughts. And we'll drop those into the comments, of course, in the YouTube channel, and we can work through those and have a read through. Coming up next week, we spoke with Deputy Chief Investment Officer of Jamison Coote Bonds, Kate Samran-Way. Kate joins us this week from Singapore to share her wealth of experience in one of Australia's leading bond trading houses, including how bonds have had a primary role in properly constructed portfolios, some reflection on their performance in 2020, and where she sees some real opportunity for high quality bonds in 2021. So tune in next week, Thursday the 24th of December, 12:30 p.m. for our chat with Kate. And thanks to all of those who have watched in live for another great episode, and to all those that have asked questions as well. We had some great questions today. I hope you've taken away some great ideas, and if you haven't already, feel free to click like on the video to give us some feedback. If you'd like to see more of our content, head over to nucleuswealth.com/content. And to stay up to date with news from us, follow us on social media. And finally, if you know anyone that would get something out of today's episode, feel free to let them know about it, share with a friend, and help our show grow. Thanks for tuning in from myself, Tim Fuller, and the team.